Hello, clients and friends. This is Craig Llewellyn from U.S. Investors International, and it is my pleasure to present our second quarter economic review. We believe an informed client is our best client. As you watch this, please keep in mind it is a review of the second quarter, which includes the months of April, May, and June of 2026. The second quarter of 2026 demonstrated an important lesson for investors. Markets can continue to advance even when uncertainty dominates the headlines. Persistent inflation concerns, heightened geopolitical tensions, high energy prices, and evolving expectations for Federal Reserve policy all contributed to periods of market volatility. However, despite these headwinds, U.S. equities recovered from a difficult first quarter, and in fact, equities once again reached new highs during the second quarter. After a down first quarter, both the S&P 500 and the Dow Jones Industrial Indexes made impressive rebounds. The S&P 500 closed the quarter at 7,499, up 14.4%. The Dow Jones Industrial Average closed the quarter at 52,319, gaining approximately 12.8% for the quarter. Now, at the last 3 weeks here, as we moved into the third quarter, the markets have moved down again with the renewed activity in the Middle East. So it seems to be so far this year, 2 steps forward, 1 step back, and I think we continue to see that. Inflation is clearly something that investors need to pay attention to, and according to May data from the Bureau of Labor Statistics, the core consumer price index, which excludes food and energy, increased 2.9% year over year. Food prices rose 3.1%, while shelter costs, the largest component of the CPI, increased 3.4% from a year earlier. At their June meeting, the Federal Open Market Committee brought updated inflation forecasts, and in March, Fed members projected that the Personal Consumption Expenditure Price Index would end 2026 at an annual rate of 2.7%. By June, that estimate had been revised upward to 3.6%, while core PCE, which excludes food and energy prices, were projected to finish the year at 3.3%. The Federal Reserve is still looking for an inflation rate of 2% or less. However, this may not be accomplished for some time. Inflation numbers are subject we need to watch carefully. During the first half of 2026, the Federal Open Market Committee kept its benchmark federal funds rate unchanged at all 4 of its meetings, maintaining the target range of 3.5 to 3.7%. Looking ahead, based on their current meeting notes, the prospect of a rate cut in 2026 appears increasingly unlikely. In fact, the possibility of a rate increase later this year has gained momentum. The path forward will largely depend on the trajectory of inflation, labor market conditions, and overall economic growth. And certainly the Middle East is playing a role in this with the prices of oil. This is a big unknown how long this goes on. Interest rates remain a critical factor of financial planning and investment decision-making. We will continue to monitor this important economic indicator closely and provide updates as changes evolve. Treasury yields remain elevated as investors continue to consider the prospect of higher for longer interest rates. As the quarter ended, the 10-year Treasury yield was 4.44%, the 5-year Treasury yield was 4.19%, and the 30-year Treasury yield was 4.91%. Bond behavior continues to hinge on the direction of interest rates. Earlier in the year, the Fed anticipated potential rate cuts in 2026. To date, we have not had one, and at the last Fed meeting in June, the sentiment took a more hawkish turn on whether or not we will see interest rate cuts this year, and possibly even see a rate hike in the fall. Should the Fed pursue rate cuts, existing bonds could appreciate in value. Conversely, expectation of slower or easing persistent inflation pressures could push yields higher and bond prices lower. Remember, bond prices and interest rates go against each other. Although expectations for the timing and pace of future interest rate adjustments continue to shift, treasuries and bonds can remain an important component of diversified investment portfolios. They may offer a relatively less volatile alternative to equities, particularly during periods of heightened market uncertainty. At the same time, the possibility of rising interest rates could create price volatility for existing bonds. Please remember that while diversification of your portfolio can help you pursue your goals, it does not ensure a profit or guarantee against loss. And we have been using money markets and CDs continually here as a bond alternative to give some stability, as it's getting you about at this point about the same as bonds are, and we expect we'll continue to do this until we start seeing some clearer picture of where interest rates are headed and where inflation's headed, so forth. And that really, again, depends on the Middle East. As you can see here, the energy sector by far has been a major upward contributor to inflation numbers. National gasoline prices increased significantly during the second quarter of 2026. Average After averaging approximately $2.98 per gallon at the end of February, the national average climbed to approximately $4.56 per gallon by mid-May. Now that had come back down, but now it's going back up as of this morning. I think it was 4.11 was the national average. So we've been moving back up with the renewed activity in the Middle East. As the quarter neared its end, oil prices moderated as geopolitical tensions in the Middle East eased. Again, they've intensified since this. So that just tells you if we see things changing and the fighting decreases, we can see what's going to happen here. And while recent declines in oil prices have provided some relief, uncertainty in the Middle East still remains. So we're still down from the May area, but we're headed back up at this point. And because the Middle East remains a critical source of global oil production and exports, developments in the region continue to have a meaningful influence on energy prices and investor sentiment. And that we've seen that very clearly. And we will continue to monitor developments in global energy markets and assess their potential impact on inflation, interest rates, corporate earnings, and overall market performance. But safety still comes at a cost, and sadly, many major banks are still only offering low interest rates to savers. According to Barron's, the average bank money market rate on June 29, 2026 was 0.51%, and the average 12-month CD rate was 1.94%. Again, we can shop these. We can do better than this. We've done that for a lot of you, and we will continue to do that. But for anyone who's interested in exploring sources of better interest rates, please give us a holler. Looking ahead, we remain cautiously optimistic. Although volatile is expected, the combination of healthy corporate earnings and resilient economy provides a supportive backdrop for investors as we move through the remainder of 2026. Corporate earnings here is a big, big deal. They are coming in incredibly strong. It's, I think, almost to a point I've never seen before. We'll see here as we move forward. In summary, uncertainty and volatility remain and are likely to be here for a while. However, equities continue to be resilient. Strong corporate earnings, again, is the foundation of this. A reasonable U.S. economy and continued enthusiasm for artificial intelligence and technological innovation all help drive broad-based market returns, and they're going to continue to do that. The Federal Reserve kept interest rates unchanged. I think they probably will through the year, but we'll see. They remained at 3.5% to 3.75%. However, their notes show that the Fed has taken a more hawkish approach to interest rate changes for the remainder of the year. Inflation remains inflamed, particularly due to the energy sector and oil prices, again, with the Middle East. Treasury yields remain elevated as investors continue to consider the prospect of higher for longer interest rates. We will continue to monitor all these items, all these key items that continue to fuel volatility, including oil prices, the path of inflation and interest rates, and geopolitical uncertainty. Focusing on your long-term goals and staying the course with a well-guided plan can help you stay grounded and confident during these times of uncertainty. We're here for you. Please reach out with any questions or concerns. Your financial well-being is always our priority. And once again, thank you for your trust in us. One of our main objectives is to keep our clients informed, and we appreciate you taking the time to watch this update. We appreciate you coming to our workshops. Again, that's all to keep you informed on topics of the moment and a way to educate you and how these things play out. Remember, a lot of you have a week from this Friday, the July 31st. We've got a little over 1 week left in July and now we're into August. This year's flying. But anyway, a week from Friday is the Hops game. If you haven't signed up for that, we'd love to have you. Contact these guys or sign up through the website. You can always call our office and talk to anybody and they can get you on the list. So with that, thank you for watching this update. Please feel comfortable sharing it with anyone else you think can benefit from it. Have a great week ahead.